Welcome to the snapshot version for both payroll and personal cycle, as well as capital acquisition and payment cycle. Now, this is going to be the quickest of all the snapshots we're going to have, as our discussion for these two cycles are relatively short. So, previously, we were able to talk about the sales and collection cycle, as well as the acquisition and payment cycle, both of which are expected to have high volume transactions. And we also talked about the inventory and warehousing cycle. So, right about now, we're going to talk about the payroll and personal cycle in the Philippine licensure examinations for CPAs. This is referred to as the cycle of hire to retire. So essentially, there is only one major transaction for this cycle, and that is of course payroll. So here are the business functions that we might observe while auditing this cycle. There's of course the hiring and the employment, the timekeeping and the payroll, the payment of payroll, and the payment of mandatory deductions. Now, we would notice that the name of this cycle is payroll and personnel. Personnel here actually refers to that which we traditionally call as HR or human resource. So, with HR or the personnel or human resource department would, of course, lie the role and the responsibility of authorization, the hiring, the promotion, the authorization of the pay rates. So all of these will happen under the personnel department or the HR department. Okay, so payroll and personal cycle only has one class of transaction, as what we have mentioned, and that is, of course, the payment of payroll. And internal controls in this cycle are generally effective even for small companies. The reason being that if you mess with people's pay, then they will surely complain. So the fact that the employees of the company are expected to be proactive when it comes to discrepancies in their pay. They are expected to complain if there are any discrepancies or deficiencies in the amount that you get to pay them. Then that somehow forces the business to shape up their internal controls relating to this particular cycle. However, if upon the evaluation and assessment of the auditor there is a significant risk over payroll, then the auditor needs to perform expanded testing. These expanded testing would involve, for example, testing on whether separation or segregation of duties is being observed, and maybe testing for ghost employees, this one referring to occurrence or existence of the employees. Sometimes when there are employees being kept on the payroll but they are actually not there, okay, or there is another person who will collect the payroll in place of these ghost employees. So if the auditor has assessed that there is a high risk of material misstatement for this cycle, then the auditor will test for ghost employees, as well as tests for fraudulent hours and expense reports. So in this case, we are concerned with whether the hours that were paid were actually worked for, and whether the employees that were paid are also actual employees who have worked for the company. So similar with the other cycles, we do have to remember management assertions, audit objectives, and the control activities of PIPs. Like I said, the remaining two cycles we have here are relatively short in terms of the discussion. So let's now move on to the capital acquisition and repayment cycle, together, of course, with the audit of the general cash account. So, in terms of capital acquisition and repayment, we refer to long term debt and equity. Now, we get to understand and appreciate, I think, as early as now, that there are few transactions for this, but they are individually significant. So think about the difference between accounts payable and notes payable, for example, right? So when the business raises funds through long-term debt, we don't actually expect this one to happen very frequently. But the moment it happens, then we already expect that the amount should be or expected to be material. So there may be a few transactions, but they are individually significant. And it is important to establish the legal relationship and presence of covenants if there are any, which will lead us back to perhaps your discussion in financial accounting and reporting on what will be the consequence should there be a breach of covenant for long term debt, right? So, if you remember that one, when there is a breach of covenant, this will immediately convert the long term debt to current debt, thereby possibly jeopardizing the liquidity of the company. So, the auditor needs to establish and look into the legal relationships and presence of covenants if there are any. Now, in terms of the audit of cash or general cash, cash is deemed to be significant even if it is not material. Meaning to say, even if the ending balance of cash is not material, it will still be tested, okay? Because it is considered to be significant. This is the most liquid asset, and because of its liquidity, it is therefore seen to be one with a high inherent risk, and internal controls are thus important. The auditor needs to evaluate the strength or the weakness of the internal controls related to the general cash account. Perhaps one of the things that we could imagine or think about when we talk about controls over cash, one very popular concept is, of course, the use of the imprest system, or how cash that is collected has to be deposited intact either that same day or the immediate next banking day, or how cash should be centralized. Okay, the custody and management of cash should be centralized as much as possible. So decentralizing the cash collection would simply mean that there are a lot of people responsible for the collection of cash, and that therefore there are a lot of people you have to be on the lookout for. So therefore the auditor looks into the controls that are present for the cash account. Now, part of our audit procedures will be to send a standard bank confirmation request to all the banks that the client has had transactions with, even when the bank balance or even when the cash balance in that bank is zero. Okay, so again, because cash is considered significant even if not material. Now, we also have noticed in the discussion perhaps of audit problems or audit practice, the discussion on how to perform a cash count, the determination of whether there is a cash short or over, and how cash counts from the viewpoint of the auditor must be done at random points. Okay, so that is why we call it surprise cash counts. And then, like what we have mentioned, bank confirmation must be sent to all banks that the client has had transactions with, regardless of the balance or the ending balance. Even if the balance is immaterial or zero, a bank confirmation still needs to be sent. And then, of course, there is a test of bank reconciliation. So, if you would recall, book to bank, bank to book, adjusted balance method, okay, and the expanded proof of cash. So the auditor will test that as well, and test of interbank transfers to be on the lookout for possible kiting activities. So a while back, when we talked about the sales and collection cycle, we mentioned lapping, which is the intentional misapplication of collections. This time when we talk about cash, we talk about kiting. So kiting is the manipulation of the float, okay, the time that it takes for a check to clear, for example. So kiting would happen when a client would recognize uh, an amount in cash to be present in both bank balances. So, say for example, you have Bank A and Bank B. So, the client has withdrawn the money from Bank B and transferred it to withdrawn the money from Bank A and transferred it to Bank B. However, since it has taken time for the check to clear, the client will not yet recognize the withdrawal. It would be as if the money is still in Bank A. But at the same time, the client has already recognized the deposit in Bank B. So one amount is present in both banks. So, in simplest terms, that is kiting. So, we perform tests of interbank transfers in order to be on the lookout for possible kiting activities. And similar with all other transaction cycles, again, we do have to consider management assertions, audit objectives, as well as control activities, especially those relating to PIPs. Okay, so I guess that's about it. We have completed a snapshot, just a very quick run through of all the transaction cycles, because again, the more detailed discussion of this will happen in your audit probs or audit practice classes. I don't want to intrude, so we just borrowed it very quickly for a very quick glimpse of these transaction cycles. So, good job once again, everyone. Head on over to the next snapshot. I think if you have been following the order of our snapshots, I have very good reason to believe that the next snapshot will be about audit sampling. Or if you want, you may wish to answer some multiple choice questions to somehow concretize the concepts that we have just reviewed. So I'll see you in the next snapshot.